Hello, this is Joe Silva of Silva Financial Services, and this is an introduction to fact-based investing. If the signals are flashing and the gates are all down and the whistle is blowing in vain, if you stay on the tracks ignoring the facts, then you can't blame the wreck of the train. This lyric from a tune recorded by Don McLean called "You Can't Blame the Train" applies to investing just as much as it does life in general. Today we're going to focus purely on facts as they relate to personal investing. We're going to look at an approach we call fact-based investing and compare and contrast it to other approaches you may be familiar with already. For more than a decade now, many investors have felt pretty much lost at sea. The major averages have gone nowhere for the last decade, to say nothing of the 50% declines that happened along the way. Investors largely feel that their investment portfolios, represented by these pie charts, are being tossed about by whatever storm passes through the markets. In other words, adrift with no progress. So, how did we get to this condition? Here's a quote from Albert Einstein that is right on target. He said, "The definition of insanity is doing the same thing over and over again and expecting a different result." Many investors have certainly been doing the same things over and over again, yet expecting a different result. The great majority of advice that investors have received for the last several decades has been derived from predictions about what might occur and theories about what should occur in the markets. Let's look first at predictions. Predictions come in many forms, and we used 4 of those forms to create an acronym. Predictions, opinions, outlooks, and forecasts form the acronym POOF, which reminds us how dangerous predictions can be. Everywhere you turn, you can find predictions telling you, with great confidence, what the market is going to do. From books, magazines, newspapers, TV, websites, and blogs, to shoeshine boys and cab drivers, everybody has a market prediction. Here are a couple books that were bestsellers in 1999. The authors, with perfectly sound reasoning, predicted that the market would continuously climb higher, reaching 36,000 by 2005 and 100,000 just a few years later. Kiplinger magazine called Dow 36,000, quote, "rock-solid investing advice." Many investors believed those predictions wholeheartedly and invested accordingly. Predictions, opinions, outlooks, and forecasts, POOF, are embedded in practically every segment that's broadcast on the financial news channel CNBC. Guests on CNBC are knowledgeable, well-spoken, completely rational, and frequently wrong. Here's a sampling of what was said in 2008, when investors needed good guidance the most. Even many CEOs, who should know more than anyone about the prospects for their own companies, were tragically wrong. Supposedly objective analysts like Larry Kudlow in the upper right and the Financial Times guy in the lower left were terribly wrong. And Jim Cramer's exhortation to buy, well, the best you could say about it is that it was wrong. One thing they all have in common is complete self-confidence in their predictions about what was going to happen. The other thing they all have in common is that they were completely and terribly wrong. For years, Business Week magazine's last issue of the year contained a feature in which leading market forecasters gave their predictions for the coming year. Here are their predictions for the S&P 500 for 2008, published on the very last day of 2007. In other words, these predictions were for the year that began the very next day, so it's not exactly a group of long-range predictions. In spite of that, of these 13 well-known, high-profile, and highly paid forecasters, 11 predicted a positive 2008, and some even a great 2008. One predicted a slightly down 2008, and the most negative prediction suggested just a modest decline of only 8%. The average prediction was for almost a 10% gain. The actual result of the S&P 500 index was negative 38.5%. So to say they were a bit off the mark is an understatement. Yet, investors by the millions continue to hang on every word uttered by this elite group. Are the predictions of market experts and forecasters usually right, or are we picking on them by displaying a handful of rare and unusual misfires? Not according to a study reported on by the Wall Street Journal in October 2010. Professor Philip Tetlock of the University of Pennsylvania studied 20 years of predictions from 284 experts in the field of politics and finance, which of course includes the stock market, and carefully cataloged the outcomes of a staggering 82,361 predictions. He concluded that experts are more often wrong than right, and would have done better flipping a coin. He further found that the more degrees experts have, the more likely their predictions are to be wrong, and even worse, to stay wrong. evidently because they think so much of their own opinions that they refuse to change them, even in the face of facts to the contrary. So, sadly, misfires in predicting, even from highly paid experts, seem to be the rule, not the exception. John Kenneth Galbraith, who served in economic roles in administrations from FDR to LBJ, said, "The only function of economic forecasting is to make astrology look respectable." Edgar Fiedler, an assistant secretary of the Treasury during the Carter years, had the final word on crystal balls when he said, "He who lives by the crystal ball soon learns to eat ground glass." We could probably say investors who believe in crystal balls will soon learn to eat ground glass. A very wise Yiddish proverb has this to say about the futility of trying to know the future: man plans and God laughs. We could modify that just a bit to say man predicts and God laughs. So we can safely conclude that the acronym POOF is very appropriate for predictions, opinions, outlooks, and forecasts. The other major source of investing strategies and advice are academic theories. We refer to this category of advice as theory-based investing. Chief among the academic theories that drive investing advice are the efficient market hypothesis, the rational investor theory, modern portfolio theory, the efficient frontier, and strategic asset allocation, known to many investors as pie charts. What all of these have in common is that each of them states what ought to happen and how markets and investors ought to behave, based on theoretical models and equations. Naturally, knowing what risk you are undertaking is an essential part of any activity, but what exactly is risk in investing? Most investors would agree that investment risk is a chance of substantial loss, like you might suffer during a bear market. But surprisingly, academics don't agree with that common sense view. The academic definition of investment risk is quite different. This chart represents the performance of two hypothetical investments. The top line is trending upward, but has experienced bigger wiggles along the way. The bottom line is trending downward, while experiencing smaller wiggles along the way. Academics call these wiggles variances, and their statistical measurement is called standard deviation. In academic theory, risk is frequently measured by standard deviation. The higher the standard deviation of an investment, the higher the risk. The lower the standard deviation, the lower the risk. Because the downward trending line on this chart has a lower standard deviation, this academic definition would imply it is less risky, even though it is currently trending downwards. And counterintuitively, by the same definition, the top line might be considered to be more risky and presumably less desirable, even though it is currently trending upward. This equating of investment risk with standard deviation, seemingly at odds with the common sense perception of risk as simply the chance of losing money, has nonetheless been a major factor in the creation of millions of pie charts, the ones that have guided many investors for years. For example, here's a pie chart typical of those created in the last decade for investors intending to retire in about 20 to 25 years. In other words, investors now in their early 40s. More than 70 cents of every dollar invested with this pie chart is invested in U.S. equities. Of that U.S. equity portion, almost 90 cents of every dollar put there is invested in large cap stocks. Only tiny little slivers of the U.S. holdings are left over for small cap and mid cap stocks. The reason for this huge disparity is simple. Large caps have a lower standard deviation than mid caps and small caps, and so programs and formulas that design the pie chart allocations automatically give outsized portions to the allegedly less risky slices, which are the large cap slices. Well, you've probably already guessed how that turned out. Sure enough, the supposedly lower risk large cap slices all lost money for the entire decade of December 31st, 1999 to December 31st, 2009. And the tiny slices given to the supposedly higher risk mid cap and small cap, they made money with very nice returns for the decade. But of course, the large cap allocations completely overwhelmed the tiny mid cap and small cap allocations, resulting in a loss for the entire U.S. equity portion of the pie, handing investors what the financial press has referred to as the lost decade. Perhaps most surprisingly, even at the conclusion of such a decade, large caps were still classed as lower risk than mid caps and small caps, based largely on the academic notion that risk equals standard deviation. Even though large caps lost money for the decade, they did so with lower variance and standard deviation. Another one of the most widely followed academic theories is that diversification protects investors in declining markets. The idea is that different types of investments will march to the beats of different drummers, and so theoretically, while some asset classes are going down, others might be going up. This chart shows that diversification across 9 non-fixed income asset classes works pretty well in a bull market, producing a very wide dispersion of returns, almost 300% from top to bottom. Even though all these asset classes were generally uptrending, they definitely went up at different rates, providing the desired diversity in returns. However, in the bear market that followed, the dispersion of returns collapsed dramatically. The supposed benefits of diversification across these 9 asset classes just weren't there. An almost 300% dispersion of returns during the bull market shrank to a tiny 15% dispersion of returns during the bear market. This collapse of dispersion means that the correlation of the returns among these asset classes skyrocketed. Correlation is the tendency of one asset class to behave like another. This proved the wisdom of the old Wall Street adage, the only thing that goes up in a down market is correlation. Alan Greenspan, America's chief economist during his 20-year tenure as Federal Reserve Chairman, was forced to admit that the academic theories underpinning his work were flawed. He told Congress in 2009, quote, "I was wrong. The model that I believed in for 40 years did not work." Another well-respected economist, Professor Robert Shiller of Yale University, is leading the way in blowing big holes in some of the investing world's dominant academic theories. He says bluntly, "The efficient markets theory represents one of the most remarkable errors in the history of economic thought." Since the history of economic thought goes back at least 1,000 years, that's really saying something. The Financial Crisis Inquiry Commission was established by Congress in 2009 to study and report on the causes of the recent financial crisis. The commission interviewed billionaire investor George Soros, and the interview was short and blunt. Soros stated that the academic theories believed in by both regulators and investors, quote, proved to be false. Specifically, he blamed belief in the efficient market hypothesis and the rational expectations theory not just for making the crisis worse, but for actually being the principal causes of the crisis. The Myth of the Rational Market, published in 2009, relates in great detail the origins and history of the major academic investing theories. As the title implies, the author concluded that those theories are myths. One of the surprising revelations in the book is that academics stubbornly stuck with flawed theories, even when faced with substantial evidence to the contrary, largely because their flawed theories were mathematically modelable and nicely fit their existing equations. They seem to prefer the neat and tidy models and equations that define their flawed theories to the more messy and chaotic market realities which might resist mathematical modeling. In summary, we have good reason to reject both prediction-based investing and theory-based investing. But what can we turn to instead? Is there a better way? Well, let's revisit that great Don McLean lyric. We believe that facts are as useful in the stock market as they are at a railroad crossing. We call our approach fact-based investing, in contrast to the prediction-based and academic theory-based methods we just looked at. Here are the 3 major characteristics of fact-based investing. First, and most importantly, there are no predictions in fact-based investing. We get our marching orders instead from what is, and not from the prediction-oriented what might be. Second, fact-based investing makes no assumptions about market efficiency or rationality. Fact-based investing embraces the reality of inefficient, irrational markets and tries to use those characteristics to our advantage. Third, fact-based investing does not remain fully invested regardless of bear market circumstances. So, when the lights are flashing and the gates are down and the whistle's blowing in vain, we get the heck off the track and out of the market. The focus of fact-based investing is entirely on careful measurements of what is, rather than emphasizing the predictions of what might happen tomorrow or the theories of what ought to happen tomorrow. We zero in on measurements that reflect a continuous tug-of-war between supply and demand. We believe that every single tick in the market and every trend results from imbalances in supply and demand. After all, if there are no imbalances of supply and demand, prices wouldn't budge at all. And longer-running trends are, in our view, driven by longer-term imbalances in supply and demand. From our supply and demand analysis, we arrive at 2 truths about the market. The first of these truths, derived from supply and demand, is that markets trend, and frequently trend for years at a time. Trends can occur in any time frame, from intraday to multi-decade. The most useful trends for us are those that last from months to years at a time, commonly known as bull markets or bear markets. And the fact that markets are irrational and prone to excesses can actually work to our advantage, because irrationality typically extends trends both up and down. A great example of how irrationality can extend a trend occurred in the late 90s. On December 5, 1996, Alan Greenspan gave his famous irrational exuberance speech to the Economics Club of Washington, D.C. In that speech, he identified U.S. tech stocks and Tokyo real estate as displaying irrational exuberance. On that day, the tech-heavy NASDAQ 100 closed at 835.80. Paying no attention to Mr. Greenspan, demand, irrational or not, powered the NASDAQ 100 to an astounding five-fold increase before finally topping at 4,704 in March of 2000, more than 3 years later. At the other extreme, bear markets frequently go lower than rational analysts suggest, as panic selling and other irrational get-me-out-of-the-heck behavior steepens the decline in a bear market. Here's a 110-year view of the U.S. stock market. It clearly shows that the market benefits from multi-year periods of dramatically rising prices called secular bull markets, followed by multi-year periods during which the market suffers big hits and goes nowhere overall. These are called secular bear markets, and we are currently in one of those periods. In secular bull markets, demand is clearly and conspicuously in control, whereas in secular bear markets, supply and demand fight a seesaw battle, with each gaining the upper hand for periods of time. During a secular bear market, it is very difficult for a buy and hold investor to do well, but for fact-based investing, there can be opportunities. Let's zero in on the go-nowhere period of the current secular bear, the period from 2000 till now. Even here, in a period when the S&P 500 has produced no net gains for more than 10 years, there have been two distinct downtrends and two distinct uptrends, ranging in duration from 1.5 to 5 years each. These are called cyclical bull markets and cyclical bear markets, known popularly as simply bull markets and bear markets. Our fact-based investing methodology seeks to identify and capitalize on these kinds of bull and bear trends in order to profit from an otherwise unrewarding market. The second truth derived from supply and demand analysis applies to the selection of portfolio components. In fact-based investing, the selection of portfolio components is based upon the tendency of performance to persist. Researchers have labeled this phenomenon as momentum and have documented its widespread existence in the markets over a span of many decades. In his second law of motion, Sir Isaac Newton said that a body in motion tends to stay in motion. Similarly, in the stock market, high performance has been shown to be more likely to continue than to reverse at any given time. The same holds true for low performance. It too has been shown to be more likely to continue than to reverse at any given time. Using continuous measurements of what is, fact-based investing simply selects high performers in portfolios and excludes low performers. Fact-based investing makes no attempt to predict future changes or the next big thing. Instead, fact-based investing relies on careful measurements of actual performance to guide portfolio construction. Our implementation of a fact-based strategy requires just two kinds of tools. Tools to identify bull and bear trends, and tools to identify high-performance portfolio candidates. Here's our primary tool for identifying major trends, called the bull-bear indicator. The job of the bull-bear indicator is to determine when a new bull market or a new bear market has emerged. Once again, this is a measurement of what is, with no predictions or academic theories involved. Our goal is to be defensive and protected in bear markets and to be fully invested during bull markets. The second tool of our fact-based strategy seeks to identify high-performance portfolio candidates. Momentum, relative strength, rate of change, nearness to 52-week highs, and other measurements of performance characteristics are all combined to produce rankings of portfolio candidates. High performers are selected, low performers are discarded, and the whole process is repeated at regular intervals, usually quarterly. This process of continuous self-renewal is intended to capture the benefits of long-term winners without being dragged down by the unnecessary inclusion of underperformers. Combining these two tools gives us a simple yet complete strategy, providing guidance on when to be defensive and when to be offensive, and when we are offensive, how to construct high-performance portfolios. Fact-based investing, concentrating on the what is of market supply and demand, rejects the what might be of prediction-based investing and the what ought to be of theory-based investing. By combining trend identification and high-performance portfolio selection, our fact-based investing strategy gives us what we believe to be the best chance of achieving our twin goals: to prosper in bulls and to be protected in bears. Thank you for viewing our presentation. I hope it was of value to you. If you believe that fact-based investing can be of benefit to you, or if you have any questions, please feel free to contact us. We look forward to hearing from you.